session. An important factor to consider is that currencies go through periods of strength and weakness. For example, if you want to trade euro-pound during the London session, you need to ensure that one currency is weak and the other is strong. This is the only way euro-pound will experience significant movement. However, if both currencies are strong, the market is more likely to consolidate, making it difficult to trade effectively. So, it's best to trade a currency pair where one currency is actively traded while the other is closed. For example, trading euro-yen during the London session works well because the euro is heavily traded, while the yen is less active compared to other currencies. So the euro-yen price movements are influenced primarily by the euro, resulting in large price trends and movements that we want to see during the London session. Finally, in the New York session, the US dollar, Canadian dollar, pound, euro, and Swiss franc are the most actively traded currencies. Since the USD is involved in the majority of forex transactions, this session sees significant liquidity and volatility, especially in USD pairs. Additionally, the overlap between the London and New York sessions creates some of the most active trading hours of the day, leading to increased price movements and strong trends. A crucial factor to consider in the New York session is the impact of economic news releases. Major U.S. reports, such as the inflation data, interest rate decisions, GDP reports, and Federal Reserve statements, are often released during or just before the session opens. These news events can cause sudden spikes in volatility, driving the market up or down regardless of technical analysis. This is why it's essential to check the economic calendar before trading in the New York session. Another important factor to consider when trading forex is the correlation between currency pairs. Correlation refers to how two currency pairs move in relation to each other. Some pairs tend to move in the same direction, while others move in opposite directions. When you analyze euro-yen and pound-yen during the Asian session, you'll notice they tend to move in the same direction. This happens because the yen is the only currency actively traded in these pairs during this time, meaning their price movements are primarily driven by the yen's strength or weakness. However, if you look at Aussie yen, you'll see that its movement isn't as predictable as the other three. That's because both the Australian dollar and the yen are actively traded during the Asian session. This creates a kind of battle between the two currencies, leading to less clear price movement. Here's an important takeaway. When selecting trades, it's best to choose pairs where one currency is the dominant factor in that session. Pairs like pound-yen, euro-yen, and dollar-yen in the Asian session are ideal because they're influenced by just one actively traded currency, the yen. This gives you a clearer picture of price movement and better trade opportunities. Now let's move on to the third key difference between the sessions, which is the price action. In the forex market, time and price are connected, with volume affecting price movement throughout the day. When you look at major currency pairs, you'll notice some common patterns at different times, which can give you good opportunities. The Asian session is often about consolidation and forming key levels. Because the volume is low, the market tends to stay within a small range, and price action during this time helps set up for bigger moves later. The London session is known for breakouts and continuation. As more participants enter the market and volume increases, the price usually moves strongly in one direction, breaking out of the range from the Asian session. This is when you can follow the trend and make profits. The New York session is known for reversals. When New York opens, many people take profits or change positions, which can cause the price to move in the opposite direction of the London session. This creates new opportunities for you to make trades in the opposite direction. These patterns happen often enough to help you build a strategy, so you can predict price movements based on how each session works. So far, we've explored how currency pairs behave during major trading sessions. But what about gold? If you observe gold's price action on the chart, you'll notice that it is actively traded across all sessions. This means there's consistently good trading volume, allowing us to catch opportunities throughout the day. However, gold is well known for its deep retracements, often shaking out weak hands before continuing its trend. So, what's the best way to trade it? One of the most effective strategies for trading gold is trend-following setups using Fibonacci retracements to pinpoint ideal entry points. To identify these entry points, we use 61.8% and 78.6% Fibonacci retracement levels. In an uptrend, look for buying opportunities when gold retraces to these levels and starts showing signs of reversing. In a downtrend, consider shorting when the price